You are listening to The Vocal Technologist. Spoken tech for your ears.
If you are building anything right now, I mean, especially in tech, the pace is it's relentless.
Oh, absolutely.
It feels less like building a company and more like trying to surf a tsunami.
That's a good way to put it. You're just getting hammered by this constant flood of data, announcements, market reports.
Every single day. So that's the whole mission for this exploration, really. We've waded through a whole collection of recent insights and data to try and find the actual aha moments for you.
But cut through the clutter.
Exactly, to deliver something you can actually use right now.
Okay, so to start, let's do an AI reality check.
Yeah.
Because the term AI has, for a lot of people, just become synonymous with large language model.
Right.
And that's a pretty dangerous simplification if you're trying to build something with, durable value.
I couldn't agree more. We hear about LLMs constantly, and the enthusiasm is great, I get it. But that narrow focus can make you miss where the actual bankable value is being created.
Exactly. I mean, when we really look at what's working, the value is so much broader. We're talking about other types of models that have been around for a while.
Like what?
Well, established classification models, super accurate audio transcription models, specialized risk analysis systems, and of course, sophisticated driving models. These have been providing billions of dollars in real, tangible value for years.
That's such a crucial distinction. It's a whole toolkit, not just one buzzy hammer.
Right.
But let's stick with the LLMs for a second, because that's where all the attention and, frankly, the money is right now. The material we looked at suggests that even within that huge category, only a few things are really working as standalone products.
That is a critical insight.
Yeah.
Our analysis shows there are basically 3 successful types of large language model products that are reliably working and scaling.
Okay.
First, you have chatbots, the comprehensive conversational interface,
Yeah.
often trained on very domain-specific data.
Makes sense.
Second, coding completion products. Pretty straightforward. Tools that make developers faster. And third, agentic products.
Okay, let's pause on that one. Agentic. What does that actually mean for a founder who's thinking about building one?
Agentic means the product can take, definitive autonomous actions. It's not just summarizing text.
So it does things.
It does things. Think of an agent that gets a customer ticket, queries 3 internal databases to find the root cause, drafts the resolution, and then, and this is the key part, it actually executes the refund. All without a human touching it.
That capability to execute, not just communicate. I get it.
That's the whole ball game.
So where does that leave all the other stuff we see everywhere, like summarization, translation?
They're features. Undeniably useful, but the data is pretty clear. They function as features of a larger product, not as enduring standalone companies themselves.
And that leads to this trend we're seeing, right? All these new neolabs popping up, focused on fine-tuning or niche tools.
Yeah, and the prognosis there is, well, it's cautious.
That's
Because the underlying foundation models are proving so fast that the value of that niche fine-tuning it evaporates quickly. The suggestion is that many of these will just end up as tuck-in acquisitions.
So they get bought by the big player.
Exactly. They won't become enduring platforms because the real value is drifting. Well, it's drifting down stack toward the data and infrastructure layer.
When you say drifting down stack, what does that mean in practical terms?
It means you're forced to focus less on the slick UI and more on the infrastructure and how you handle the data. You're basically being pushed to become an infrastructure-adjacent agent lab to capture value closer to the models themselves.
Okay, let's unpack that. If we know what to build, we have to talk about who builds it, and the team structure stuff we looked at. It's kind of startling.
It's a radical transformation, isn't it? If you're building today, having an AI component in your team is not optional anymore. It's just a strategic necessity.
And it comes down to unit economics.
It's relentless. It's almost impossible to justify hiring humans for a lot of back office functions. I mean, tutoring an AI system is just so much faster and cheaper than training a new employee.
And the number that jumped out at me was this move toward a 60% AI team model.
Right.
But the human cost, that was the part that really got me.
The loneliness factor. It's real. An AI-optimized team is a quiet one.
How so?
Well, when coordination is automated, when systems build out features based on API calls instead of meetings, the meetings just disappear. And so do those little moments, after work drinks, water cooler chats. They just evaporate.
That's a huge cultural shift. You gain efficiency, but you lose that human glue. Are there any suggestions on how founders can deal with that?
It's about being deliberate. really delivered about high-quality human interaction. If you cut out the daily friction, you have to replace it with something structured.
Like offsites.
Exactly. Focused, strategic offsites or mandatory, purely social team events. You have to accept that the old, organic culture just isn't going to form on its own anymore.
A challenging paradox. Now, within this lean team, there's one human role that's just exploding in growth. The forward deployed engineer. What's driving the FDE boom?
The core reason is simple. AI deployment is hard. It is not drag and drop.
Right.
It's one thing to build a great model in the lab. It's another thing entirely to make it work in a customer's messy, real-world environment. FDEs bridge that gap.
So if you're listening and you want to future-proof your career, what's the FDE profile look like?
It's a hybrid role, part senior software engineer, part technical consultant. They don't just sell, they embed. They're literally deploying code and troubleshooting integrations with the customer.
What are the skills?
You need deep Python. You have to be comfortable with AI and ML concepts. You need amazing customer-facing skills. And you have to be ready to travel.
Sounds like a job for a polymath. So this connects to the underlying infrastructure, right?
Absolutely. We're seeing two massive themes playing out. First is the big push for U.S. infrastructure onshoring. Chip manufacturing, supply chains, all of it.
A national security play.
And an economic one. The second theme is Alphabet aggressively trying to expand their TPU penetration beyond just their own internal workloads.
TPUs, they're custom chips for machine learning.
Exactly. By pushing them externally, they're trying to make PPUs a default standard for AI to diversify the compute landscape away from being just about GPUs. And that changes the unit economics for every founder building on the cloud.
Okay, let's pivot now. From internal operations to the external world. The money, the market, the valuations. The headlines make the funding environment feel, I don't know, completely schizophrenic.
They do. But you got to look past the day-to-day. There was a huge positive sign recently. October 2025 saw the highest level of unicorn production in over 3 years.
Wow.
We had 20 companies add, $44.5 billion in value in a single month.
20 new unicorns in a month is a serious surge, and I'm guessing AI-native startups are getting a disproportionate slice of that pie.
Oh, massively so. The bar is still incredibly high, but the valuations for those that make it are they're substantial.
So here's where it gets really interesting for me. IPO pricing. When these companies finally go public, the day one volatility is just chaotic. Why is it so unstable?
It's a perfect storm. For years, the IPO window was basically shut, which created this enormous pent-up demand.
So investors are starved for new listings.
They're starved, so anything that comes to market gets swarmed. Then you layer on a general bull market where even shaky companies feel safe enough.
But wait, aren't the banks supposed to anchor the price to, peer multiples to something rational? How can algorithms just override that?
Well, they try to anchor, but that's just the starting point.
Yeah.
The second trading starts, the algorithms jump on every tiny price move and amplify it exponentially.
So a 2% tick-up becomes
a flood of automated buying to chase a momentum. That algorithmic amplification, plus the human demand, is why those day one moves catch everyone, including the banks, off guard.
So what's the takeaway for a founder watching this madness? Are we in a bubble that's about to burst?
The founder mindset on this is really pragmatic. The advice is basically this. Great founders live on such a long timeline, like 10, 20 years, that any single bubble has a much smaller impact.
So if the money is there,
you should probably take it, even if you think a bust is coming. That capital will be crucial for weathering the storm that follows. You have to play the market you're in today.
Build with the resources you have. I like that. Okay, speaking of wisdom, let's pivot from the financial stuff to leadership. The material puts a big emphasis on something called founder energy.
Yes, and founder energy is that sense of infectious momentum the leaders have. It's absolutely vital for two things, recruiting great talent and fundraising.
Why does energy matter so much when the product is so technical? Shouldn't investors just look at the code?
Because every key stakeholder, they're making a bet on the people. An employee taking a pay cut, an investor writing a huge check.
Right.
They're betting on the founders, first and foremost.
So the energy is a signal.
It's a signal that this ship is moving fast, that the person at the helm is completely committed. It gives everyone else confidence.
And that speed is critical because scaling is, well, it's notoriously difficult. Going from 10 people to 100 isn't just simple addition.
It's a fundamental shift. You have to deliberately break what's working. What got you to 10 people will absolutely crash and burn at 50. Scaling is about multiplication, not addition.
I love that phrase. For our listener, what does multiplication look like in practice?
It means building systems, robust infrastructure, good documentation, clear decision-making frameworks, things that let 5 engineers on a distributed team ship features without needing constant sign-off from you. You're multiplying capacity through leverage.
And that investment in leverage brings up another common trap, the platform PM myth.
Right, the myth that every single platform investment has to have an immediate positive ROI. It's short-sighted. Because platform innovations are the foundation. They might not be sexy user-facing features, but they are crucial for long-term scalability, security, and just staying competitive. Sometimes you have to make those long-term bets.
Okay, we've covered a lot. Product, people, scaling, markets. If we strip it all away, though, what's the single biggest failure trap for a high-potential startup?
The material is very clear, and it's alarming. The statistic you just can't ignore is this. 65% of high-potential startups fail due to co-founder conflict.
65%? Wow, that's not a market failure or a tech problem, it's a people problem.
A huge one.
I see this time and again, which is why I often dedicate time on my show, Vocal Technologist, to that founder dynamic.
Wow.
It so often stems from convenience, right? Choosing a college roommate instead of a strategic partner.
Precisely. They might have a shared history, but they don't have complementary skills, or even worse, they're not aligned on core values.
Yeah.
So, what's the fix?
It has to be something in the communication structure.
It is. The solution is what's termed meta-communication and containment strategies.
So, talking about how you talk.
Exactly. You need to agree on the rules of engagement when things are good, so that a disagreement about a product feature doesn't escalate into a personal war that derails the entire company.
This has been an incredibly dense look at everything a founder is facing. We started with that harsh reality that really only 3 types of LLM products are working as standalone companies.
And we followed that all the way to the need for the forward-deployed engineer to manage all that complexity, balanced against the weird, lonely culture of the 60% AI team.
Then we landed on the market dynamics, the chaos of IPOs, and that core question of whether to take the money when it's there, even if you think a bubble is forming. The insights today should hopefully give you a real advantage.
So here's the final thought we want to leave you with, something to consider. Founders rarely talk about this inner struggle between 2 competing demands. Chasing these huge disruptive goals, the relentless scale, and wanting an inner life that isn't completely ruled by striving. Stillness.
The burnout versus the breakthrough.
It's a tension every single builder faces.
So the question for you is, how do you reconcile stillness and scale in your own journey? Something to ponder as you build your empire. Until next time.
Talk soon.
Spoken Tech for your ears.